Okay, well, I don't know. He's not there. I, it's like all of a sudden he just got lost, and he was on a roll.
The prior speaker?
The keynote speaker was there, and then he just fell off.
The leadership guy?
So I'm waiting for Dr. Davis, Arthur Davis. Let me see where he is.
All right, I'm gonna check my ability to share my screen.
Okay.
Okay, so hold on, just tell me if it's working.
All right. Yeah, your screen is showing. Can you see it?
I can see it, and you can see it?
Yes.
Okay.
Okay, Arthur is having an issue getting on, so we may have to roll without him.
Is my face too dark?
No, you're okay.
Okay.
All right, since we have people on here, we're going to go ahead and get started. So good morning, everyone. My name is Valeria Cummings-Swope. I am the Community Liaison and Development Manager for the Department of Economic Inclusion for the City of Cincinnati. And I'd like to welcome you to Building Wealth and Closing the Wealth Gap. Our panelists for today are Ann Ritchie and Arthur Davis III. Arthur will be joining us. He's having an issue trying to get on, but he should be here shortly. But in the meantime, we have Ann, and Ann is a capital provider and trust advisor for businesses. Her experience is in venture capital, corporate restructuring, and bankruptcy, and provides a unique perspective for creating capital solutions when risk is significant. And growing passion for solving the access to capital gap for women and minority companies is her expertise. So thanks, Ann, for being with us this morning.
You're welcome.
So let's start off with letting you tell those who are here a little bit about yourself and what you're going to be talking about.
Sounds good. Good morning. Welcome to this session. This is my one of several sessions I'm doing this week, so I had to get my house all prepared. Okay. But my background is a little unusual, so I'm going to walk you through maybe in more length, just so that hopefully it will drive you to figure out what kind of questions that you think would be relevant for my background. So I am I'm a banker. I started out in banking 20 years ago, and I did my first transaction was a leveraged buyout, and then after that I did bad, and after that I spent 20 years in workouts and restructurings. And what that is that's the part of the bank where loans that the bank have hit a bump, they lost a customer, something changed in their industry, but they need to be managed separately from the other assets at the bank. And usually they either become rehabilitated and go back to the normal part of the bank, or they go through a bankruptcy process or liquidation. So I have about 20 years of experience watching companies fail. And what happens there is after about year 5, you just start to see the same mistakes. So there's maybe 5 or 10 categories of what happens when a business fails, but it does give you a perspective about how to build a company. So I did that for 20 years. Then I spent about 3 years as an operator doing a turnaround myself. It was a jet airline parts manufacturer in Harrisburg, Pennsylvania. We had 3 customers. We had a 500,000 square foot plant. We had 250 employees, but it was 2008. So what happened, I think it was a private equity backed spinoff of TRW. and it was marketed to me as a 80-20, 50-50 chance of survival, and it was really more like 80-20. So we ended up liquidating the company. The bank got paid in full. But that was those 3 years in my career where I learned 20 years worth of lessons. After that, I kind of gave up working with distressed companies and I started working with growth companies. And so I have clients on my own. I also worked with Jumpstart, which is a venture capital organization funded by the state of Ohio. And so I worked with early stage tech startups there. And I also teach for Goldman Sachs 10,000 Small Businesses, which are tech or non-tech businesses that are put through a program to try to develop growth plans. And again, the reason that I'm going into such detail is it provides a different perspective, kind of going from early stage to mid stage and then to companies that are unfortunately dying. I have an undergraduate in economics and a graduate finance, MBA in finance. And so I'm going to share my screen just to show you the outline that we're going to try to work off of today. Do this.
Okay. Oh, okay. I'm sorry.
Okay. So here's kind of the outline of what I thought I would do. Introductions. I want to throw some data out there and really talk about what we were going
Hold on just a minute, Ann. Arthur, you need to put your computer down because we're getting feedback.
Okay.
Or something, because when you came on, we're getting feedback as if you have two systems on. Do you have your phone on too?
All right, hold on.
If you have it on your phone and on your computer, we're getting feedback.
Okay, no. Is that better now?
Yes. No, we're not getting feedback now.
Okay, all right.
All right. Go ahead, Ann. I'm sorry.
I'm sorry.
Okay, so this is just an outline of what we're hopefully going to cover today. Introductions, insights from the data, and again, I think there's so much data going around, but I really want to spend a little time talking about and discussing interactively what the data means for us. I have some operating company solutions. My partner panelist has some real estate solutions, and then we'll do Q&A. I think the chat is open, and so any questions you have along the way, it would be great to see, because I think it's really important, especially at this time, that the content, what you're most interested in, what's top of mind for you. Sorry, I'm going to share my screen again so I can just walk you through some of the data. And this is none of this is new. I'm sure you all have heard these numbers, and more importantly, I'm sure you've lived them because I presume most of you are business owners, but I think it's worth talking about. Entrepreneurship is the fastest way to create wealth for Black people. There's been a lot of studies that show that the primary reason Black people go into business is to escape bad employment situations. That is a nuance of our population as compared to other minorities. Black business owners have 12 times the wealth of their non-entrepreneur counterparts, which again is a strong case for using entrepreneurship to close that gap. Of course, I'm a finance person, so I only look through one lens. To me, it is the only way to close the wealth gap. It would take a long time. Here it says 228 years. If we keep doing what we're doing, it will take 228 years for us to reach the wealth that white families have today. And so I'm very passionate about shortening that 228 years to something that we can hopefully all live and see. On the bottom left, 90% of Black businesses have no employees other than the business owners. So those are mostly sole proprietorships. Now that number is higher than for the general population, but it's not drastically higher. So I think for non-minority companies, it's closer to 70 or 80%, but most of our businesses, 90%, have no employees. And then the second pie chart shows that an estimated 50% of our businesses will fail due to COVID. So when you combine a 50% fail rate with the fact that 90% have no employees, then what you're really looking at is a almost complete elimination of our business base if we don't do something different.
We're not seeing your slides, Ann.
You're not seeing my slide?
No.
Okay. You're seeing me instead of my slide?
Yeah, well, before we could see you and the slides, but now we just see you.
Okay. Well, I can keep going without seeing the slides.
Okay.
Do you see anything now? Or no?
It's coming up. We see your screen now.
Okay.
There it is. Now just make it full screen.
Okay. Not sure what went off, but okay. So, and then in the bottom, the last data point at the bottom really shows what's happening in Ohio. In Ohio, believe it or not, Ohio is one of the 8 largest states with the most Black businesses. Our closure rate for February through June was actually higher than 50%. It was 59%. Now, some of those have reopened and some will not close permanently, but I've heard statistics as high as 60% of our businesses will fail, which is very devastating. And then on the far right is just a graph to show that, you know, the average revenue of a non-Black company is over $500,000. The average revenue for a Black business is under 100,000. And so there's also data that shows that as we grow, that revenue gap actually increases. So all of this to me makes a very, very strong case for not panic, but intentional efforts to scale businesses. As long as we are operating in the riskiest part of the business landscape, now it's COVID, but it could be a recession, we're always going to be extremely vulnerable. And so I'm very passionate about trying to rapidly scale businesses so that we are disproportionately represented in the businesses that are most frail. And they're most frail because 1, they're small businesses. 2, they don't have, they're in industries that are very risky. African Americans over-index in low margin service businesses. Also different than other minorities, our businesses are hyper local because we tend to start businesses that serve our own population, which is great because we do want the corner store to be owned and operated by people that reflect the demographic of the neighborhood. But on the other hand, those businesses are by nature very frail. So I am all about trying to scale businesses. There are also solutions for those 90% of businesses that are sole proprietor. I accept the fact that a lot of people just want to be self-employed and not have a large business and so I have concepts that will hopefully help those businesses as well. We're not going to cover those today, but I do think that there needs to be concerted, intentional effort to protect some of those sole proprietorships. But again, today I'm more focusing on the businesses that are larger and want to grow and want to scale. And so to me, this data points to the fact that we need to move quickly. If most of our businesses are going to fail, or 50% or 60%, I think we need to move quickly to reverse that trend. And when I talk about speed, it's speed to, one, revive your own business, but also strategically to look at the businesses. So, most of the problems that have been uncovered with COVID, everything has changed with COVID, but nothing has really changed. It's just putting a very strong spotlight on trends that were already there and that pre-existed. Now, more than ever, speed is important because the current funding of PPP and other efforts to save our businesses are disproportionately focused on smaller businesses. And so we need to change that, and we need to understand that time is not on our side. If the PPP got you through 6 months, there's another 6 months coming, and probably another 6 months after that, according to what the health experts are saying. And the longer we take to figure out how we're going to fix this, the worse off we are. So one of the number one tenets of a workout or a restructuring of a company is time is never on your side. It always takes twice as long to accomplish things, and you run out of money twice as fast. And so I think every business at this point needs a very, very tangible, actionable plan that accelerates the decision-making process. And sometimes that's just deciding, if you can't make the decision today, it's deciding when you can make the decision. And that could be the decision to lay off. It could be a decision to close. Whatever decision you make, you have to keep a cadence to your decision-making, because again, time only reduces your capital available in your runway. The next kind of very important thing is strategy and intent. And so on the micro level, when we look at our businesses and we're facing COVID, we figure out, what is our value proposition? What is going to help us get out of this? And are we going to get out of this? And again, if not, make decisions to reallocate our resources. This is a very unique time in history where there's a disproportionate, there's a relationship between capital available and risk that will not exist in 6 months. So you can get a PPP loan for $500,000 to keep your restaurant open. Again, a year from now, it's going to be very hard to get $500,000 to open a restaurant. And so I think there's opportunities in that there is capital available. It's just critically important that you not follow your gut or your heart and put your money back into a business that maybe has no solution. From a macro point of view, I think the money that's going in microloans and micro businesses needs to be reallocated to businesses that have scale and have the potential to increase their scale. Collaboration. I think it's more than ever, it's extremely important for us to collaborate. We are not going to get to scale by organic growth in our businesses. So this means acquiring technology. This means acquiring competitors. This could mean backward integration, forward integration, but no longer feeling like we want to do it on our own. More so than other minorities, African Americans tend to want to start businesses with by themselves. And, if you're looking at venture funding or private equity or anywhere in between, funders are always looking for someone to have a partner or a stronger bench or a stronger management team. And I think now is a good time to really think about how we can collaborate more. And again, if you are unfortunately in an industry that's dying or shrinking, are there opportunities to merge or joint venture with other competitors to make one strong business versus 2 or 3 failed businesses? Specifically in terms of operating keys to try to scale, I think there's 5 things that I've seen over the year that really contribute to a company's ability to scale and success in scaling. One is accurate and timely financial. I think more than ever, the PPP process highlighted the fact that you need to have your numbers accurate at all times so that when you see an opportunity, you don't have to spend some time putting your numbers together. It's also a time when you need to evaluate your numbers forensically and say, is this product line, store location, plant, whatever it is it really contributing to my margins the way I think it is? A lot of times when you try to scale, you've got to figure out what's the most profitable part of your business and where you want to grow it and where's the best opportunity. And you can't do that unless you have accurate and timely financial statements. Second is the team. Frequently we hear that we can't, the majority population has trouble finding our talent. We know our talent, we know where it is. We just have to make sure that we have the correct team for scaling. It's very difficult sometimes to scale when you have smaller businesses because you can't afford the resources and you can't afford to make it in choosing the wrong resource. The great thing now is there's a lot of gig workers and there's a lot of people out of work. So again, if you can't hire a full-time CFO or a full-time digital marketing person, there's a lot of talent out there that can be, I use Upwork myself, but if you don't have the networks, you can go online and find professionals that are vetted that can do certain tasks that enhance the team that you have full-time. Define sales process, that's pretty obvious. I think we need to grow our businesses from entrepreneurship managed to professionally managed, and this sales process is one area where I see a lot of room for improvement in terms of having a lot of stuff in your head but not having a defined process that someone else can step into. See, the founder and the CEO is the primary salesperson, but that doesn't mean that you still don't want a defined process so that when you get to the point where you are no longer the primary salesperson, you have a process that you can hand to someone else. Achievable and measurable plan, that's pretty straightforward. As a banker, I can't tell you how many times people came to look for money and they were probably maybe 12 to 18 months away from really being able to say, this is how much I need, this is what I'm going to use it for, and this is how it's going to help me scale my business. That's really important. And again, these all work together because your team and your financials should drive your plan. And then again, aligned and experienced leadership. I consider anyone in business in this environment to be extremely brave and capable. And so I think now is the time where that leadership can really stand out. I worry that a little bit of the free money that's out there and the confusion of COVID is a distraction, and it's a distraction at a time when we really need to be innovating, and that's kind of where the leadership comes in. Really great companies were built out of 2008, but it was leadership that allowed that process to happen, and that's not easy in this kind of environment. So that's kind of my quick walkthrough of what I think needs to happen. I'm hopeful that there is so much attention being paid on minority businesses at this time that I think if we can stay focused on scaling and stabilizing our industries and our businesses, I think it can be a time for huge growth. On the downside, I worry that if we fall into the trap trying to prop up industries or businesses that are going to be frail, then we will take our eye off the ball and miss the opportunities to really make a difference in closing that wealth gap through entrepreneurship. So that's kind of the operating side. I would defer to Arthur the real estate side, and he can introduce himself. But I think, from my opinion, I've always operated on the operating company side. But I think if you look at the wealth historically that has been accumulated, it really is real estate that drives it, and we are absolutely absent in that part of the business.
All right, thank you, Ann. And I'd like to introduce to those who are with us now, Arthur Davis III, who's co-founder and owner of the Davis Group, which is a real estate investment company. Mr. Davis has over 30 years of experience in acquiring real estate properties and an extensive background in banking and finance. And so I'm going to let you go ahead, Arthur, and pick up where Ann left off.
Sure. I think one of the main things that impede Black businesses from growing is the lack of access to capital. I've seen over the years where individuals have had really good ideas, but unfortunately they weren't able to fund those ideas or bring them to the marketplace. I've been involved in real estate for several years now, as was stated. My initial background is in commercial banking, being a loan officer, credit review officer, workout officer, in those capacities. And through those particular functions, it introduced me to real estate. I just happen to have a lot of real estate investors who were clients, some real estate developers who were clients as well. So it gave me an opportunity to be exposed to that particular aspect of the real estate market. Another aspect is the equities market. Became involved in that and introduced to that by doing quite a bit of research over the years. And the two things that I'd like to allude to in these two regards is that they both provide you with ownership. I think the biggest gap with regards to minorities and Blacks and brown people from that perspective is the lack of ownership in any particular type of business. Given the fact that this is a capitalistic society, and traditionally, what has happened is that we've had a lot of our white counterparts who have had heavily invested in the stock market. We've also had them invested in the real estate market as well. And as those markets have been appreciated and grown over the years, then the wealth gap has grown over the years as well. So I think that ownership is really key. For me, it's been real estate, primarily real estate because of the fact that it provides you with cash flow and also the opportunity to experience some appreciation in your assets over time. So what we've done over time is try to build a portfolio in that regard. Most of the assets in that portfolio are small to mid-sized apartment buildings that we've purchased and invested in. And again, I'll go back to my initial comment. The biggest detriment to doing that is access to capital and also access to credit. Credit for us, it really wasn't a problem, but the capital aspect of it was. And it continues to be to some extent, primarily from the standpoint of maintaining a certain amount of control over the business. I'm sure that we can collaborate with other individuals, and at some point we probably will have to do so more in the future. But primarily at this point, it is the access to capital that has limited us and also other individuals that we know with regards to achieving some of the goals that we like to achieve going forward. But primarily, real estate investment has been very good from the standpoint of generating cash flow, allowing us to collaborate with other individuals from time to time with regards to researching properties, reviewing properties, and also ultimately sourcing and managing those particular properties.
Thank you, Arthur. We had a question that came up in the chat, and it says, what are we doing? What are we going to do collectively to grow Black businesses? And I'll throw that out to both of you.
Okay. Well, what I would say to grow Black businesses, I think that, again, we need to have avenues to capital. I think capital accessibility is key. The experience associated with whatever respective business that you're involved in is key. I gained my experience primarily from the clients that I had at the bank and working with them. But I think the main thing is to own something that is going to appreciate and generate cash flow, which ultimately will generate employment opportunities within your community. We employ quite a few people with regards to contractors. Our business model is based on independent contractors. So I have independent contractors in all aspects of the business. And a lot of those businesses, a lot of those independent contractors are within the Black community. And we've been able to network with them and work with them and ultimately pump money back into the community.
I see for me, the three biggest, I see three big initiatives that can help us grow Black businesses. One was a perfect setup for a pitch. I am starting a mezzanine debt fund for businesses owned by women, people of color, and it capital that banks would not have the appetite for, but it doesn't require, risk doesn't require getting partners. So it's in between debt and equity, and it really is growth capital aimed at leaving the ownership with the business. Venture capital is great, a lot of money going into it, but it's extremely, an extremely closed circle, and it does not usually create a Black business because the model is the 20% usually succeed by selling to a mature company like Google, the big exit. And so I think one key is flexible capital. I think another key to growing businesses is co-ops and cooperatives and things where ownership is shared and owners are, these become part owners in businesses. It shows that those tend to perform if they're managed correctly, and also you make 20 owners out of the company. And I think lastly is just the position of predominantly businesses. There are a ton of businesses, especially in the state of Ohio, that are owned by majority that don't have plans. This happened in 2008 as well. And you know, this is the 75-year-old owner that is not interested in trying to rebuild after COVID. I think there will be a lot of opportunities for, you know, the fastest way to make a 50 million business for a Black person to buy an existing business. And I think there are going to be a lot of those opportunities. I focus intently on the capital. It's a issue. I think there's a lot of money out there now. I think people are naive about how the money they're putting into the market is going to be impactful. Because we also need the VC, we need the mezzanine, we need private equity. We also need traditional bank loans, which are very hard to get. There's a lot of money going into, going slowly going into Black and brown.
Okay, and we're losing you in and out. I'm not sure exactly why. We can hear you, but we can't see you now. I don't know what's going on with your signal. There you are.
Is that better?
Yeah, it's better.
Okay.
Okay. Something that you brought up earlier, and I'm gonna throw this out also, is you said that COVID is a distraction, but in this day and age of COVID and what it has done to small businesses in general, how do businesses pivot in this type of world we're in now? We hear a lot about the PPP loans and businesses trying to survive and having to look at what they do differently. But how do small businesses survive and build wealth in this world we're in today?
I think a key, and it's easy for me to say because I'm not one of those business owners, I think a key is really looking in the mirror and seeing if you're in an industry that is going to be around and going to be around the way you want it to be around. And I'm not picking on restaurants, but they're the easiest examples. Restaurants operate on 5% margins in good times. And so they're frail businesses by nature. Because of our our culture, we tend to go into those businesses because it's what we know and there's low barriers to entry. But restaurants are hard businesses to be in anyway. And so I think part of it is if you really being honest with yourself about the industry you're in, and if it's not one that you see surviving or thriving post-COVID, taking your research or skills to another industry. Entrepreneurs are, to me, some of the bravest and most ambitious people I meet. And so if you're in one of those industries, I recommend to my clients, get all the cash you can, stockpile it, and figure out what your next move is. And those are for the few that are in industries that are really, really, really going to struggle. I think if you are in an industry or in a business that has a decent chance of survival, you need to think about putting a pause. I've seen at least 5 clients mothball their plant at this point and just say, I'm coming back in a year or 6 months. Limping along is hard to do. And then if you're in the third category where you are not hit that hard, then you need to, again, stockpile and gather all the cash you can and figure out how you become more viable in post-COVID. And the obvious ones are, you have to be more digitally capable, you have to be more remote, but you've also just got to be more nimble. And in that last category, you've got to stay and get really close to your customers during this period of time so that when opportunities start coming out, you're the first call because you're the one that's been in touch with them all along.
I have someone who says, it's from Danita Smith. She has a startup cosmetology and barbering school under one roof. And she also has a Pay It Forward campaign project. And she's been trying to get capital since early last year. And she says, what about businesses like hers? And also if you're receiving or applying for disability.
I'm not, go ahead.
Go ahead.
I'm not sure I understood the disability question. But cosmetology is one of those industries that I think it's a little better than restaurants because there's a necessity part to it. But it's also the delivery method is going to drastically change. And so if I were starting out in cosmetology, I'd be trying to figure out how this service is going to get delivered post-COVID. And I'm not necessarily sure what that is, but it's a lot of technology about scheduling and not having people waiting and comment. It's about being able to deliver safely and nimbly, maybe without the retail or as large a retail space as you required. I think there's a shortage, or pre-COVID, there was a shortage of professionals in cosmetology and barbering. So I think a school is a great idea, but you have to make sure that there's going to be the demand for those career options in the future.
Okay, I have a question from a Will Carter. He said they are a shared ownership platform. However, they are challenged to find capital support to go through the SEC process, need 100K for that. So how do they connect with that kind of money?
On the co-op, I'm assuming if he's talking about co-ops, there are a few. I only know Cleveland. In Cleveland, there is a co-op fund that will, and what the fund does is they buy companies that they think have the potential to be co-ops, and then they convert them to co-ops, usually not through an ESOP, but just through a cooperative agreement. So that's one resource that I know for co-ops, if that's what Will is talking about.
He says they're a startup. Why Prosper? Whyprosper.com. So they're a startup, yeah.
If you're a startup, then I would recommend some of the startup organizations that fund. Again, venture is extremely hard to get. I think we only get 2% of it, but there is a lot of money going into it now.
Okay. I had another question, and that is, doing my research for this workshop, I saw that it said something that said, while the number of minority-owned businesses is growing, there are about 1.1 million missing businesses in the U.S. due to historical discrimination against certain minority groups. So it's saying that while minority businesses in general are growing, I guess where there's opportunities, we're missing those opportunities. And I'm wondering why that's happening. Are we not looking in the right places to open up businesses? Are we always going in the same general areas that most businesses go into?
In my opinion, I think we are going into the wrong businesses. So we are the largest, how do I say it? We are the fastest growing business starters right now. And women of color out index in starting businesses like 2 to 1. So we are the ones starting the businesses. But again, keep in mind that those 2 data points. One, we usually start businesses escaping bad employment situations. So that's where you successfully hang up your shingle and say, I'm going to do this on my own, which is considered in the number as a business, but it really is a self-employment job. And also, I think we tend to go into businesses with low barriers to entry. So we're going into business. It's a cycle. So we're going into businesses that don't require a lot of capital and have low margin. And then that makes those businesses less attractive for investors. You know, venture capital is only looking at companies that have huge market potential. And we tend to go into lower margin businesses, and we also go into businesses that sell to our own. So Asian minorities index the opposite way. They tend to not start businesses that sell to their own. They start businesses that sell to other demographics, which greatly accelerates their growth prospect.
Your feeling, Arthur?
Well, I think that the main thing associated with creating the wealth and getting through this particular period of time is just to be as nimble as possible and adaptive. We really have to adapt to the situations that we're dealing with right now. I think if you had a viable business before the virus hit, you probably still have a viable business now. The only difference is if you can adapt your access to capital, your access to credit, will you be able to work your way through this particular period of time? And I think that those that fortunately are able to do so can. Going back to the credit issue and the access to capital issue, what we initially started off doing initially from the very beginning was, and I'm not recommending this to all individuals, is that we had to leverage our assets. We had to leverage our assets in order to generate the capital, to take that capital, to put that in down payment on a building, for example. And then fortunately during this particular time, we were able to refinance the property and then get the money back out and then go on to the next particular project. But that is really key during this particular time is to, as they say personally, to have an emergency fund. You have some money set aside from the standpoint that you can get through this particular difficult period and adapt to hopefully get through it and make it to the other side.
I have a question from one of our people that are listening. He wants to know, are college student rentals a good business to go into?
I would have said yes up until the COVID virus hit. And I would say yes after the COVID virus hit. But after it leaves us. My initial push from a marketing standpoint has not been so much college students. Although some of my buildings are in a college town. We have some buildings in Syracuse market, for example. I've historically had more experience or had more good experience with individuals who are basically your middle market or your middle income type of renter. Someone who is going to be there for not only a year, but maybe 2, 3, 4, or 5 years. My only concern with the college rental market is that every year you have to turn those apartments over. And I don't mean to get into the weeds, but what happens is when you turn them over, then you're outlaying cash, and then they're coming back in, and you're doing it all over again. So from a continuity standpoint, I've just had better experience with individuals who basically are just middle-income individuals with families that need some good housing.
Okay, there's a conversation that some of our people watching would like to get started, and that is on supporting Black businesses. We, as a group of people, have a tendency not to support our own. I mean, that's just part of what it is. And it can't be that the answer can't be to go ask those that discriminate us to help us do big things. So how do we change the conversation to get minorities to support other minority businesses and to help us as a group to get our businesses really to succeed?
I have a general feeling about that. We had some friends over the weekend, and we were talking about the same thing, real estate related. If I were going to start a business outside of what I'm doing right now, I would do something that was going to cater to the mass market. I would want to do something that's not going to cater so much solely to the Black community, because just as you indicate, unfortunately, the Black community has not supported Black businesses as effectively as other ethnic groups have. For example, Indians in our community. We have Indian stores and Indian shops, and if you go there on any weekend, they're filled up with Indian patrons. So what I would really want to do is to create a business just like Amazon or something similar to that markets to everyone. That way you can make money in the mass market from white Americans, Black, brown Americans, internationally as well. Then what you do with that money is up to you. Now, if you want to take that money and you want to invest it back in the Black community, then that would be a good way to do it. Preferably what I would want to do is, if I was going to do something like that, I would want to employ individuals in the Black community. Bring money into the Black community in that particular fashion. That would be my
Well, I guess my question is, why don't we support each other? Is that back to that whole historical aspect of the slavery issue and the light skin versus the dark skin versus the medium skin versus all of that? I mean, is that still playing a factor in all of this today?
I think a lot of that has to do with it. In the Black community, we just don't have the financial resources that other communities have in general. So if, for example, I have friends that I went to school with many years ago, and they're still at this point trying to create businesses to cater specifically to the Black market. I would cater to the Black market. I would cater to the white market. I would cater to the brown market. I would cater to from a global standpoint, just like other businesses do. Because from my perspective, what that does is it gives you a better opportunity to succeed. If I only deal with the Black community, and the Black community has limited resources, then I'm kind of hindered. But if I deal with a lot of different type of groups on a global or national basis, and then we draw that particular capital into our business, I can then employ people. That money goes into their communities, and that's going to better their lifestyle.
You wanted to add something, Ann?
Well, I think there is a strong historical context to why we don't support our own businesses. I'm hopeful that things will change, but I don't necessarily, I think a lot of it has to do with a lot of stuff that happened way before I was born, in terms of the mentality of our race. But I don't think it's insurmountable. I've met Black companies that don't want to collaborate, and I've met a lot that do. And I think increasingly we have to look for that collaboration and seek it out and be patient with people. I also think that a lot of this, I kind of agree with some of the comments in the chat that we have to be more self-sustaining, and so we need more Black investors to invest in Black companies. We also need to question the funding mechanisms that have been in existence a long time. CRA is very focused on neighborhood, but not focused on race or gender. And so banks or whoever wrote the legislation, it's written for low to moderate income neighborhoods or people living in those neighborhoods, which is not the same as race. And so I think it has a tendency to drive people to stay in those low to moderate income neighborhoods when that might not be the best place for them to be located. Again, if you're selling to that neighborhood or if there is a strong reason to be there, physical plant wise, that's fine. But saying you can only get this money if you're in this neighborhood, I think creates a perpetual system. And so I think we have to challenge those systems. In starting my fund, everyone keeps asking me, are you going to make loans in this geography? And to me, that goes against, the idea of increasing shareholder wealth. I want to look at companies that are located where they need to be located because that's the best business. That's the best business location for them. And as people become more less place-based, especially now with COVID, it should not matter where the business is located to attract funding. And so again, there is money that needs to be poured into core cities, but in terms of solving the racial wealth gap, geography needs to be taken off the table because when they figured out how to start Google, nobody thought, oh, you need to locate in this 2-mile radius. I also think venture, there's a lot of money, a lot of investor money, athletes and entertainers putting their money into venture, which is great, but they need to make sure that it's venture that is decisioned by people that look like the founders, because the bias is real and strong and hard to overcome. We will not overcome the bias. We just have to work around it and make sure that the people deploying the capital reflect the people receiving the capital. I mean, the data is out there that Black fund managers outperform, and fund managers that invest in Black companies outperform. And so that should be top of mind when we think about how resources are allocated. We don't necessarily need a white venture firm to say, we're going to start investing in diverse companies. We need a white venture firm to say, here's $50 million for Black people to invest in Black companies, because the bias, I've sat in the investment decision rooms and the bias is strong, very strong.
Two things. One is, let me find this one. A comment came back and said, it's not a matter of support, it's a matter of value. And then there was another comment that said, do you feel that you are connected to current Black wealth in Cincinnati and will personally be committed to connecting us to, and will you all be personally connected to connecting us together?
I would pass that question.
So, when I look at Ohio, we got Cleveland, Columbus, the 3 C's in their minds have always dominated the state, which is not really true when you look at Black businesses. And Cincinnati, to me, outpaces Cleveland. And, I can say that because I'm from Cleveland, because of the efforts of Procter & Gamble and some of the other initiatives in Cincinnati, GE. There's more Black successful businesses in Cincinnati than Cleveland because of supplier diversity efforts 20 years ago. Cleveland was a steel town and steel companies sold to other steel companies, and they did not have strong supplier diversity that created the 15 to 20 million revenue businesses that we see in Cincinnati, or Detroit because of automotive, or Dayton because of the government contracts. So I feel like I want to get introduced to Cincinnati because I think there's a lot of there's a group of P&G retired professionals that have a fund, and I think we can all learn a lot. I also think that we need to again, start thinking regionally, nationally, and internationally. I've never seen a company either through Goldman Sachs or through Jumpstart come in with a global strategy. It's always local or hyper local, and we need to start thinking much bigger, add a zero to everything we do, and really,
I don't, if I could jump in, I really don't believe that to be successful, a Black business has to directly market their services or products to Black consumers. Nobody else does that. Apple doesn't do that. Amazon doesn't do that. You know, some of your major corporations, they don't do that. They market to everyone. I mean, I'm not saying you may not have a particular target market or you may not have your particular niche, but why not expand your net as wide as possible to provide your services to whoever you can provide them to? And then once you make that particular amount of money that you're looking to make, if you want to then invest it in the Black community, maybe do some scholarship funds, offer scholarships to some kids or something like that in the community. Maybe you want to do some workshops and stuff like that for individuals. But you're going to work with a much larger pool, a bucket of money than you would normally if your Black business only were to focus on Black consumers, because nobody else does that. I mean, we're a minority in this country. The majority.
There's also I think there's there's a lot of vocabulary and mindsets that keep us kind of spinning, and it's put upon us by the other populations, but it's also in our population. You know, the concept of a lifestyle business. To me, there is no such thing as a lifestyle business. It's a lifestyle mindset. I've seen an orthodontia office that now has 15 offices. They have a school for assistants. And so that traditionally would have been called a lifestyle business because it's one person doing their trade. But we need to release those concepts and really change the mindset. And any business, almost any business can be scaled if you want to scale it. There's dental office chains now. You know, we also need to think about backward integration. There's a lot of industries where we are the predominant consumers, but we don't own the value chain. We don't manufacture, we don't distribute. You know, the obvious one is beauty care products. We're making a lot of progress there now, but we still over-index on the consumer side as opposed to owning distributorships. And what happens if some of the salon owners shutter their stores for 6 months, put their money together, and buy a distributorship or form a distributorship? So when they open back up, they're buying their own supplies from a company or another part of their company that will give them a little more stickiness and a little more stability in an industry that is undergoing some pretty significant changes.
I asked, for those who are taking part in this webinar, I put out the question, I said, what kind of businesses are participating? And I've got event planning business, beauty and barbershop. I've got a cookie creative business. I've got commercial interior, architectural walls, Alzur Studio, custom online and e-mobile computer training and consulting, fine tech fund, a bakery, creative services, web design, Machiavelli Construction and Associates. So we've got a vast array of businesses that are participating in this webinar. And it brings to the question, we also have a construction company. So it brings into question, we have this vast array of all of these businesses listening in, and how do we go about, how do these businesses go about creating wealth and shrinking the wealth inequity that it exists between the haves and the have-nots? You know,
I think one pattern I did see is of the businesses you named,
mm-hmm.
The only one that has a gross margin of higher than 50% probably is the fintech, which is, and maybe construction depending, but technology companies have 70% gross margins. The rest of these businesses you're talking about have very thin margins, or they're in thinner margin, in that thinner margin category. So in those businesses, if that's your passion, we have to figure out a way to consolidate those businesses, roll them up, and put tech in. Because if you're operating a bakery or a hair salon or a design company, the only way to increase your margins is through technology or scale. And so can you find a competitor? I tell the companies all the time that bid, look who else is bidding, call them up and see if there's a joint project that's larger that you two can go into to test the waters to see if that's someone that you might want to partner with on a long-term basis. I mean, some of the margins in these businesses can be improved if the overhead is shared over a larger customer base. And the fastest way to do that is to merge or joint venture on some stuff. But again, the industries you mentioned are all thinner margin industries, which is part of this cycle. And it's, you can't tell a cosmetologist to go run a tech company because that's not their passion, but you can tell that cosmetologist to partner with others, buying co-ops, federations, landscaping businesses, put your money together, put your PPP money and go buy a robotic lawnmower, whatever the new technology in your industry is. You're not going to be able to access it as a sole proprietor. You're going to need volume, and volume makes you more attractive to investors. And if 5 of you go to an investor and say, I want to buy a scheduling system for my hair salon, you're more likely to be successful that way than just trying to do it on your own.
You're shaking your head, yes, Arthur. So what ideas do you have for these companies?
Very similar type of ideas. I think the main thing to do is to have a very flexible and adaptive business plan, so that you can make changes in the marketplace as the market changes, especially during these particular periods of time. With regards to assessing capital, again, that's difficult. You just need to have a very, very good business, a viable business that you can pursue. And then hopefully it will attract some capital, or you can maybe get some conventional financing through banks, things of that particular nature. Or maybe you can get some investors to step into in your business and invest in that particular fashion. But I think the main thing to do is to look to be adaptive, to be flexible in the marketplace, and to basically serve the needs of your particular target market and your clientele.
I would also make the note that there are ways to merge and partner without losing your identity. I get a lot of, when I was with Jumpstart, I get a lot of independent food concepts. Somebody's got a hot sauce, somebody's got a pound cake. Nabisco is 50 brands and you don't even know that they're owned by the same company. And so merging or combining doesn't necessarily mean you lose your identity. If we had a platform of web designers, creative services, where somebody could go on and find 15 providers, those 15 are not necessarily your competition. They're broadening your base. And so if you stick with your specialty, you can leverage off of other people's specialties. I mean, we don't have a national Black law firm. We don't have a national accounting firm, but we have tons of extremely strong lawyers and accountants out there that are kind of doing it on their own. And their, economies of scale are real. Especially, I was when I was looking at the law firm. I do this in my spare time. I was looking at the law firms that got the government contracts to write the stimulus plan. There was no law firm that was anywhere, there was no Black law firm that was anywhere near large enough to get that contract. But if 6 of them would have, 6 regional ones had gotten together to bid on that contract, and that's a government contract, and it was huge. They probably could have gotten it because they have the expertise from working at the white law firm that they left to start their own. So I do think we really need to collaborate more.
So what can be done to help businesses get through the crisis we're facing right now? We've talked a lot about looking down the road. We've talked about doing right now, but rolling all of this up, looking ahead, what advice can you give businesses to get through what we're seeing today, to move ahead as we go towards 2021 and beyond?
Well, I think the main thing that we can do right now is to just show up your businesses. You're gonna have to make some changes with regards to how you do business in a particular marketplace. You may have to cut your costs. You may have to improve your margins in that regard if you can't do it on the top line. Just to get through this particular period of time, so that you can get to the other side, and hopefully things will improve at that point.
That's the $1 million question, right? I think it's number one, making sure you're really being objective about your likelihood of survival. And then I'm just encouraging my clients to really go line by line on their balance sheet and income statement. On the income statement, what expenses can you convert from fixed to variable? Can you ask your landlord, hey, I don't want a waiver of rent, I just want to set my rent based on revenues for 6 months? Can you say to your employees, I can't give you a raise, or I have to maybe lower your salary, but I'll give you some upside based on revenue when we get them, just to get that fixed overhead down and to get the variable costs up. Because when you engage your landlord and your employees and other stakeholders in your success, I think you have a greater likelihood of success. And it's the good thing is it's a time when you can ask for anything. Nobody's going to look at you like you're crazy. You can almost negotiate anything. It doesn't mean you're going to get exactly what you want, but it's a time where people are making concessions. Your insurance, my revenue went down. Can I lower my insurance and report monthly on my revenue to see if I need to go back up to the higher levels? Just little things like that. And then on the balance sheet, really looking at what liabilities you can freeze, debt payments, and what assets you can accelerate. Can you get your large corporate customers to pay you faster, pay you quicker? Can you sell your receivables to generate cash? Can you ask a customer to take more inventory sooner than they would? Again, it doesn't always mean that you're going to get engagement, but that kind of back and forth, it builds trust, and it also aligns your interests so that hopefully everybody has a better path forward.
And Arthur, as someone who has experience in the banking and finance areas, I think a big part of that is also making sure you have that relationship with your bank person.
Yes, absolutely. I think that's really key, because that's your lifeline in most cases. Whether it's a line of credit, working line of credit, a term loan, equipment loan, money for leasehold improvements, or a mortgage to buy your building and operate. It's very important to maintain those relationships throughout the whole process, not only during this COVID-19 particular period. But if I could just make a comment about the earlier about this whole particular environment, what I've noticed is some businesses have been disproportionately impacted more severely than others. I see a lot of on the comments about people in construction and related type of activities and industries. I've noticed that during this COVID-19 process, March and April and part of May were very difficult for everybody. But then I've also noticed that around Memorial Day, the end of Memorial Day, all these companies that were related to construction contractors, construction industries, have been really, really, really busy. really busy, even given this particular COVID-19 period. Things had backed up for a couple of months, but now I'm working on a couple of projects. I can barely get contractors to show up at those particular sites to do work because they're so busy. I mean, everybody is coming into the market to get things done. So it's really kind of affected people disproportionately from one business to another. The beauty salons and beauty shops and barbershops, I know in New Jersey, for example, have only recently started opening within the last 2 weeks. But like I said, a lot of the construction-related trades and contractor trades, they're so busy that you can't get an appointment for at least a month or two at this point. So it's kind of different and kind of varies. But the main thing with regards to, again, closing this whole gap with regards to wealth is ownership. Is black people in general, we just haven't really owned very much. So we live in a capitalistic society, and it's based upon owning assets that appreciate over time and create value. That's the main difference in the value gap in this country, in my opinion. Those that are invested in the stock market, those have been fortunate enough to have or operate a business, and even those have been even more fortunate to bring that business to the marketplace and take it public. And then also, again, drawing on that pool of capital that exists in the world today. So I think these are some of the things that we need to do, but if we can just get the ownership aspect down, which it sounds like a lot of businesses, they are owning it, if they can get access to capital, if they can get access to the expertise that they need to grow their business, and if they can gain that experience, then they can put that together and hopefully they'll have a successful plan going forward.
Don't they also need to figure out a new way to do it? I just had a thought. You know, you talked about the construction companies booming right now and construction going on. They have to eat. I remember a former director in our department, we had some type of meeting and there was a lady there that had some type of little restaurant or some type of I think it was a catering company. And we had this meeting. And so the lady was sitting there and she said, you know, if I just knew how to reach out to where the construction was going on. And the person sitting in front turned around and said, why don't you just come out where our construction's going on? Because we have lots of people who need to eat. And she gave the construction person their card and they made this connection. And so I don't know whatever became of it, but I just now thought about that. You know, maybe you have a food industry and maybe, you know, taking your truck out to where construction is going on because they have to eat. Maybe that's a new way of looking at it.
You have to adapt. You have to adapt to the environment in which you're dealing. I mean, and that would be the case minus the virus. In any business environment, you need to be able to adapt on a continual basis to the marketplace in order to serve your clients and also to compete, you know, against your competitors, you know, from that standpoint. So I would agree. Yeah, maybe you need to, if you just went to the local train station, if you had a catering a canteen truck, and that's where you normally went, well, now people aren't going to work as much as they used to. So maybe now you need to go to a different particular site. Maybe you need to go to maybe a Walmart. You know, you're going to get a lot of traffic in a Walmart or a Home Depot, which are packed, or Lowe's that are packed. Areas like this where you can access a lot of people, and then you can, you know, grow your business in that particular aspect, at least for the short term, until things get back up and running.
Yep.
So you have to be adaptive. You have to be adaptive and creative. Very creative.
That is so true. I don't know what made me think of that story, but I think creativity is the key right now, is looking at what you have and figuring out how to tweak it a bit to move it forward. Right. And then taking that concept and building upon it. And then I think the second key is what both of you talked about, and that is networking and finding others who are in the same boat or similar boat as you and working together and to build upon what you have to maybe let that be the key to getting to that next level. I don't know.
Yeah, I would also, I think staying close to your customers, because they have different kinds of needs, and you're not going to know about those needs if you're not regularly talking to them. And so some of the best pivot stories I've heard are from people who were selling one thing to their customers, stayed close and heard another need, and converted some of their services or started entirely new service providers providing different services to their customers, because those relationships are going to give you an insight into what problems your customer needs solving, and you might have the skills to solve those.
Mhm.
I so agree. So agree. I think our time is about up. I've got to figure out where my little schedule is because I don't want to go over. Oh, no, we have about 5 more minutes. Oh, wonderful, 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 wonderful. Okay, because I wanted to ask one more question, and that is if you had to tell those who are watching, if you could give them one strong piece of advice, what would it be? And I'm going to start with you, Arthur. What would it be if you could give those who are watching one strong piece of advice? What would it be?
Be steadfast. Be steadfast, and if you had a good business before the virus hit, in general, speaking of the virus, then you probably still have a good business now. And if you can adapt and make the necessary changes along the way during this particular difficult period of time, then hopefully when things recover, and they are recovering, slowly but surely, they are recovering. And I think that you'll come out well on the other end. The other thing I would say is just continue to network and do all you can to assess capital. It really comes down to the accessibility of capital. You have a lot of good ideas from Black, white, brown people, but if you don't have enough capital to bring it to the marketplace, or at least to get it off the ground, you're going to have some difficulty in doing that. And then also get the experience that you need. Don't hesitate to talk to people that you perhaps may not have spoken to before, or other business owners, and ask them how they're doing, how they're doing things, what changes are they making, to get that hands-on experience. And then also try to, if you can, get a mentor, someone in the business that you're interested in, who can thereby help you during difficult times and give you some insight with regards to some things you may be able to avoid as it relates to pitfalls, and some things you may be able to take advantage of if you hadn't thought of before.
And I guess when you talked about networking, that has changed a lot now, because we used to network in person. So now we're networking via Zoom or Facebook Live or whatever. How do you go about setting that up to network?
You know what? In real estate, in my business, before this even happened, I would speak to individuals on the phone about deals that I was interested in. And maybe that deal didn't work out, but what they ended up doing was sharing a wealth of information with me, just in general. I've never met these individuals. I've never seen them, but we would talk probably every week or every 2 weeks on the phone just about the marketplace. And they would provide me with some insights on how to go about doing business, what to look for and what not to look for as it relates to real estate, how to manage your tenants, how to manage your buildings, etc. So a lot of times you can get a lot of information, and these are individuals that I had never saw, never met, and I would just continue to talk to them over the phone with regards to what can you do to help me, or what's going on in the marketplace, or what are you seeing. And these are individuals that had been there many years before and what they would do is say, Arthur, in a situation like this is what I would do, or this is what I would do in this situation. And that 15 or 20 minutes or 30 minutes every 2 weeks was very helpful. So just connect yourself with the individuals in your particular industry, whether that even is a competitor, or maybe that's someone in a local government that probably can provide you with some assistance, and then continue to nurture those relationships to help you grow your business.
I like that. Good old-fashioned way. Pick up the phone.
Pick up the phone. You'd be surprised at how many people would be willing to help you that you never even met before. And that happened to me a lot. It happened to me more from those individuals than the people that I knew.
Wow.
That I knew in real estate.
Great piece of advice.
Right, right, right. Talk to people. Don't hesitate to talk to people. Introduce yourself. Tell them what you're doing, and they'll tell you what they did and how they did it, and then hopefully they'll provide you with some insight. So at least you have something to bounce off of. And then if they can share with you some mistakes that they made that you can avoid, then that's even better. And that happened quite a bit as well.
And if you had something to tell people, what would it be?
Well, I would ditto everything what Arthur said. I think for me, it would be collaborate. Collaborate with other people in your industry to try to get some strength and size about what you're doing. I also I've found LinkedIn. I'm in the fundraising mode, so I've got to make hundreds and hundreds of calls to even get a strong lead. And so I've really been using LinkedIn a lot, and I'm surprised at how many people I've been able to reach. Bank presidents, CEOs that actually do their own LinkedIn, and they've said, yeah, let's connect. It's been a tool that I underestimated in the past.
If I could share one additional comment real quickly, I would just advise individuals to don't be afraid of hearing the word no. Because if you're not hearing no a lot, then you're not doing enough, in my view. Because you're going to hear no a lot more than you will hear yes with regards to your endeavors and things you want to do and things you want and things of that particular nature. So don't hesitate. It's part of the process, and don't let it derail your efforts at all.
Okay, and I'd like to thank you, Arthur Davis III and Ann Ritchie, for being with us. Some great information, much appreciated. I think everybody has benefited so much from this workshop, and this is the first workshop of many to come on the next couple of days. So everybody, next up is, is a panel discussion on disparities in business and property ownership. I think we've laid the path for that workshop to start. So thank you all. Everybody else, thank you. This will be available. I saw tapes, so this will be available for anybody who needs it. I'm sure they'll share information on how to make that happen. So thank you, Ann. Thank you, Arthur, and everybody else. Enjoy the rest of the conference.
You're welcome. Thank you.
Thank you. Thank you.